Hello everyone, and welcome back to the show. Today, we're diving into a strategy designed to keep your portfolio steady, no matter what the markets throw your way. Between tariffs, inflation, ballooning government debt, and the disruptive potential of AI, it's clear we're navigating a trickier landscape than the one investors enjoyed over the last decade. Portfolio strategies that can perform across any economic environment have become increasingly important. One of the most resilient approaches in that space is the all-weather portfolio strategy, and that is what we'll be talking about today. But before we do that, let's talk about what happened in markets this week. First up, a thawing in the bond market. After the tariff tremor back on April 2nd, junk bonds went into deep freeze. Spreads spiked, liquidity dried up, and the panic was real. But fast forward to now, and things are starting to defrost. An important high-yield spread index surged to 4.61% at the peak of the drama, but it's since narrowed to 4.14%. That signals cooling nerves and maybe, just maybe, a return of risk appetite. Still, we're not out of the woods. Wide bid-ask spreads are reminding everyone that liquidity remains thin, and leveraged deals are still feeling the pinch. Private equity isn't exactly breathing easy, but a full-blown credit meltdown is off the table, at least for now. If you're eyeing junk bonds, it could be a good time to fire up the watch list. Some analysts say wait for spreads to tighten further or for yields to spike again. Either way you choose, it's a game of timing and nerve. Now, let's talk about IPOs, or rather, the one bold enough to go for it. While most of the tech IPO hopefuls, think Klarna, Chime, Plaid, you name it, are sitting on the sidelines, Figma just hit the gas. The collaborative software company has confidentially filed for an IPO, defying a market still jittery from tariff tremors. With a $12.5 billion valuation and the memory of that failed $20 billion acquisition by Adobe still fresh in people's minds, Figma's making a statement, and that is that it's ready to stand on its own. If markets calm down, Figma could go public fast, and if it prices well, this might just signal that the tech IPO window is creaking back open. It's one to keep on your radar. Over to the Fed now, and Chairman Jerome Powell isn't in any rush. He says the central bank's in a wait-and-see mode. No hikes for now, no guarantees on cuts either. But he also warned, tariffs could throw a wrench into both inflation and job growth. Markets picked up a hawkish vibe. Powell made it clear there's no Fed put to rescue equities this time. Stocks dipped on the news, and the rate path got murkier. Still, traders are now betting on 4 rate cuts by year-end, starting in June. If that plays out, we could see a rally in rate-sensitive assets. Some investors are already shifting towards dividend-rich stocks and defensive plays, bracing for more volatility ahead. Let's shift gears to Big Pharma and a possible race against the clock. US pharmaceutical imports, especially from Ireland, spiked early this year. Why was that? It looks like drug makers may be front-running potential tariffs on branded drugs. If those tariffs hit, pricing power could take a hit, and margins may shrink. US-listed pharma giants with big European Union import exposure could face cost spikes and supply chain chaos. On the flip side, generic drug makers, especially those with diversified or domestic supply chains, could be sitting pretty. Analysts are already reassessing exposure across the sector, and if tariffs gain steam, expect a shake-up in winners and losers. Speaking of shake-ups, Chinese freight is hitting rough seas. Bookings are drying up fast, and cancellations are piling up as US demand for imports plunges. Categories like apparel, furniture, and toys are especially hard hit, and ocean carriers are slashing routes in response. That could mean more pressure on US port operators, rail, and trucking stocks. Names like JB Hunt are in the crosshairs. But Vietnam, it's emerging as a trade winner. Investors are pivoting towards Southeast Asia-linked logistic and infrastructure plays as China volume takes a hit. And finally, a hit to Timo's turbocharged US growth. The bargain shopping app has slashed its US ad spending and slid off the App Store charts after Trump's new tariffs made its cross-border shipping model much pricier. With a 145% tariff rate and the de minimis duty-free threshold on its way out, Temu's facing price hikes, fewer ads, and stiff competition. Its parent company, PDD Holdings, is under pressure, and Meta might feel the punch too, since Temu was a heavy ad buyer. Analysts say it's time to reassess exposure to Chinese e-commerce names. As tariffs bite, US-based players like Amazon and Etsy could scoop up the digital foot traffic Temu's leaving behind. Now, let's dive into the main piece. A strategy for stormy markets. Right now, markets are reacting to more than just geopolitics. The US dollar is showing signs of strain. Government debt is reaching levels that demand attention. And while AI and automation hold promise, the benefits haven't fully materialized yet. From 2009 to 2020, inflation, stagflation, and other macro threats mostly stayed out of sight. That period appears to be over. Today's environment calls for more robust strategies to protect capital and navigate volatility. In recent weeks, we've looked at sector rotation, diversification, and gold as hedging tools. Now, it's time to spotlight another powerful approach: the all-weather portfolio. Historically, the 60-40 portfolio, 60% stocks and 40% bonds, was a go-to for balanced investing. It offered a mix of growth and downside protection, and for a while, it worked well. Then came a more nuanced approach: risk parity. Rather than splitting investments by dollar amounts, risk parity focuses on equalizing the risk each asset contributes to the portfolio, typically using volatility as a measure. This opened the door to more asset classes, including real estate, commodities, inflation-linked bonds, and alternatives. To ensure less volatile assets like bonds still play a meaningful role, leverage is often used. While it adds complexity, the idea behind it remains simple: diversify the risk, not just the assets. That concept is the backbone of the all-weather strategy, developed by Bridgewater Associates and launched in 1996. The strategy was designed to perform through all kinds of economic conditions and reduced reliance on market timing or economic forecasting. The entire framework rests on two forces: economic growth and inflation. These two variables drive asset prices depending on whether they're rising or falling. Together, they create four core economic seasons, each favoring different investments. Here are the four economic seasons and the types of assets that historically perform well in each. Firstly, in rising inflation, commodities like oil and gold, along with inflation-linked bonds, tend to deliver strong returns. In periods of falling inflation or outright deflation, long-term government bonds typically perform best. When growth is rising, equities and other growth-oriented assets often lead the way. And during declining growth, investors frequently move into government bonds, with interest rates typically trending lower. These four conditions don't always appear in isolation. In reality, we often experience hybrids: Goldilocks, with rising growth and falling inflation; reflation, where both growth and inflation rise together; stagflation, where growth weakens while inflation climbs; and deflation, where both indicators are in retreat. The first two scenarios often favor equities, while the latter require more defensive positioning. The all-weather approach spreads exposure across all four environments. This structure aims to deliver a portfolio that remains balanced and resilient through a variety of macroeconomic shifts. Here's what a typical all-weather allocation looks like in practice: 40% in long-term treasury bonds, 30% in equities, 15% in intermediate-term treasury bonds, 7.5% in gold, and 7.5% in commodities. It's important to note that this mix isn't focused on maximizing returns, but rather smoothing performance across different cycles. As markets shift, these allocations naturally drift, so regular rebalancing is critical to maintaining balance. For implementation, the strategy adapts easily across countries or globally. ETFs offer simple access to each component. For example, the SPY and VT provide equity exposure. TLT and IEF cover the bond allocations. TIP offers inflation protection. DBC covers a broad commodities basket, and GLD adds gold exposure. Since 2009, this portfolio structure has shown strong consistency, especially during volatile or bearish periods, often outperforming single asset classes in tough times. State Street has recently introduced a more modern version of this idea with the launch of ALLW, an ETF based on the all-weather strategy and managed in partnership with Bridgewater Associates. This fund adds a twist. It's actively managed and uses leverage, increasing total portfolio exposure to around 182% as of mid-April 2025. The use of leverage is designed to amplify the impact of lower volatility assets while preserving risk balance. This creates a more dynamic version of the classic all-weather portfolio. However, the addition of leverage also increases complexity and potential volatility. Since the ETF is newly launched and actively managed, many investors are choosing to monitor its performance over time before allocating any capital. Let's now look at the pros and cons of the all-weather strategy. On the strength side, the strategy is grounded in cause and effect relationships between macroeconomic forces and asset behavior, not just historical correlations. Secondly, it's easy to implement using widely available and low-cost ETFs. And thirdly, it's adaptable, with plenty of flexibility to adjust asset weights or apply the concept across different countries or investment preferences. But it's not without trade-offs. Firstly, long-term returns are typically more modest, usually in the 5 to 7% range annually. Secondly, the strategy is not immune to rare scenarios where both stocks and bonds fall simultaneously, as seen in 2022. And lastly, its heavy reliance on bonds may limit upside if the long-standing bond bull market truly is over and interest rates remain higher for longer. Despite those weaknesses, the strategy can evolve. Alternative assets can be introduced, and investors with a growth focus can tweak allocations while preserving the core principles. Investors who prefer building portfolios around individual stocks can also apply the all-weather framework. Each of the 4 economic seasons tends to favor different sectors or types of companies. Firstly, in Goldilocks periods, rising growth with falling inflation, cyclical sectors tend to lead. These include consumer discretionary, technology, industrials, and financials. During reflation, when both growth and inflation are rising, real assets like energy and real estate often outperform, thanks to stronger demand and pricing power. In stagflation, where growth falls but inflation rises, defensive sectors and hard asset producers are often more resilient. This includes commodity producers, gold miners, healthcare, consumer staples, and utilities. When deflation takes hold, falling growth and inflation, investors usually turn to high-quality dividend stocks and growth companies with strong balance sheets. These businesses often benefit from declining rates and a greater demand for safety. Using this seasonal lens helps identify companies and sectors positioned to hold up or even thrive under varying macro conditions. So what's the insight here? Use the portfolio tool to manage several portfolios with different objectives. At a broader level, the all-weather strategy leans more towards capital preservation than high-octane growth. That makes it ideal for wealth protection, lower volatility, and smoother returns, particularly for investors nearing retirement or those with lower risk tolerance. For investors earlier in their journey or aiming for aggressive capital growth, a more equity-heavy strategy may be a better fit. One effective solution is to run multiple strategies side by side. That could look like 2 distinct buckets. Firstly, a capital protection bucket anchored by strategies like all-weather, which is more bonds, less volatility, and consistent performance across market cycles. And secondly, a growth bucket that's more equity-driven, higher volatility, higher potential returns, and designed to take advantage of long-term compounding. The Simply Wall Street portfolio tool makes it easy to manage this dual strategy approach. Investors can build and track separate portfolios, each with its own risk profile, time horizon, and objective. You can monitor them individually, compare performance, review forecasted income, or zoom out and see how everything fits together in one big picture view. Whether you're balancing between weatherproofing and growth or experimenting with new strategies, the ability to manage multiple portfolios gives you more flexibility, more clarity, and more control. Simply sync with your brokerage account and never miss a beat with important updates sent straight to you. And that's it for today's deep dive into the all-weather portfolio strategy. Whether the goal is steady performance, downside protection, or building a macro-informed stock portfolio, this approach offers a smart framework for long-term resilience. If you'd like to read the full breakdown of these insights, we'll provide a link to the article in the description. As always, we'll be back next week with more market insights. Until then, invest well.